We'll now be moving on to our next session, which is investing in PropTech from an African LP and VC point of view. This will be presented by Zach George, Principal Alternative Equity Investment, Nedbank CIB.
Good morning, everyone. My name is Zach George. I'm the principal at Nedbank Venture Capital, and I'm going to be speaking this morning about the exponential impact and growth of venture capital in Africa. I'm going to focus on the key role of corporate startup collaboration in fueling the growth of the VC industry in Africa, and some of the lessons that we've learned from building one of the largest portfolios of early stage technology-driven startups in Africa. One of the important aspects of the demographic trends from a global population standpoint is the world's population today sits at around 7.5 billion people. And within the next 80 years, at the turn of the century, we're going to have an increase of a net new 4 to 4.5 billion people. And the staggering statistic on that is that Africa accounts for almost 85% of the net new population increase in the planet. So that creates either a massive infrastructure and logistical problem or a huge opportunity. From a VC perspective, we see that as a huge increase in consumer purchasing power and the number of people that are online, and the ability for Africa, as in the past, to leapfrog technologies as it did in the last 20 years. Out of the 20 largest cities in the world in the next 50 years, 12 of them will be on the African continent. So where does venture capital fit into this equation? So we are the fastest growing market, accounting for a third of global population by the end of the century. At the very same time, we've started from a very low base. So the African continent had only $20 million or thereabouts of venture capital in 2011. And that has leapfrogged to more than $2 billion last year. And what's interesting to note is, despite the early aftermath of COVID-19, the amount of venture capital activity in Africa has not ceased. In the first 8 months of this year alone, from January to August 2020, African technology ventures raised more than $600 million in VC funding, which was an increase from the same period in 2019. Also, not only have the amount of VC deals increased and the size increased, but the average size of the average investment round between seed, Series A, Series B, and growth stage deals has also increased every year since 2015, and from a percentage perspective, higher than any other continent. 2019 was a record-breaking year for African VC. There were more than 90 African tech startups doing funding rounds of $1 million or more, totaling more than $1.25 billion from a Series A, Series B, and Series C perspective. And what's interesting to note is the kind of investment firms investing into African early stage tech is not just focused from VCs on the continent. About 50% of all VC activity getting into Africa last year alone came from the US, Europe, and Asia, with a small participation from from South America and Australia, and the other 50% from the African continent, making a total of more than 250 VC funds. More than 70% of all this funding went into Series A and Series B deals, and from a sector perspective, the lion's share of venture capital investment went into the broad financial services industry, which included fintech and insurtech. PropTech is usually clubbed together with fintech. And then from a sort of second and third position, logistics, marketplaces, and e-commerce came a close second, followed by health tech and agri-tech. From a geographical standpoint, the majority of VC activity on the continent centers amongst three stronghold regions: Nigeria in the west, Kenya in the east, and South Africa at the south. These three geographies account for more than 60% of all venture funding on the African continent. And it's no surprise that the three dominant markets from a ecosystem perspective are Nairobi, Lagos, and Cape Town. And there are reasons for that I'll cover in the next slide. So what are some of the key components that create a thriving startup ecosystem? It's important to understand what makes Silicon Valley who they are. And I get asked this from a lot of my friends in the industry. So I happened to go to Stanford Business School 15 years ago and saw the birth of a lot of early stage tech ventures in the Valley. One of the most important things is obviously talented tech savvy entrepreneurs. So you need to have a growing class of developers, designers, digital marketers from top tier technical and business schools that opt to pursue an entrepreneurial path by working with startup founders or being founders themselves. What we've noticed is in a lot of emerging markets, including Africa, that trend seems to be slowly catching up. Most technical graduates from top business schools and PhD programs in the technical sciences tend to go to academia or consult to industry. That's changing slowly but surely. Number two, you've got to have a growing pool of risk capital, not just capital, but risk capital from high net worth individuals, family offices, and VC firms. So it's not just the amount of capital, it's the attitude towards capital. And what you see in a lot of thriving startup ecosystems like San Francisco, New York, Tel Aviv, London, Berlin, Bangalore, Beijing, etc., is you see a shift in the attitude towards risk. So whereas in more traditional ecosystems, money tends to flow into traditional asset classes like property, the stock market, asset management firms, mutual funds, etc. In more innovative ecosystems, venture capital and startup investing gets a bigger chunk of the wealth pie. A third aspect, which is often overlooked, but is especially important in emerging markets, is corporate startup collaboration. So most large banks, insurers, telcos, retailers look beyond traditional internal innovation and product development programs by venturing into external innovation. And you do that through partnerships and proof of concepts with startups. There are several examples of very powerful corporates that have created venturing arms like Google Ventures, Samsung Ventures, Microsoft Ventures, Citibank Ventures, etc. The fourth aspect is acceleration, something that I'm particularly sort of have a lot of experience in, is the emergence of accelerators, incubators, and high growth venture building studios that provide a perfect channel and means for corporates to interact with startups. And as NetBank, we've partnered with several global accelerators on the continent to help the startup industry propagate in Africa and globally. And last but not least, it's very important to have an active and willing government that helps the startup community by providing them with R&D grants, tax subsidies, and providing incentives to small and medium-sized businesses. So the important thing is these are 5 components that need to work in unison to create a thriving startup ecosystem. And although the degree of each one of these 5 components varies, Cape Town, Johannesburg, Nairobi, and Lagos exhibit qualities of these 5 components, which make them hotbeds for innovation in Africa. An important point here I wanted to make is about how do tech startups scale, including PropTech startups in Africa. It's very important as a founder to know that your route to market is one of the most important determinants of your success. So unlike Silicon Valley and more mature ecosystems, B2B business models, as in business to business models, tend to have a much higher success rate simply because the cost of acquiring customers, often called CAC in venture lingo, is a lot higher in Africa. So one of the ways to stymie that and to make up for the high customer acquisition costs when you go direct to consumer is to look at working with banks, insurers, telcos, and retailers through what's called proof of concepts, pilots, and commercial partnerships. And this is typically done through licensing agreements and JVs. or revenue sharing agreements. That's why it's very important from a tech founder perspective in Africa to look at partnerships very early on in your life cycle. And the last point I want to make here is, unlike 20 to 30 years ago, where the only way in which a founder or a tech startup would compete would be price versus quality, in today's world, it's very important to understand how your customer reacts to what you offer them, be it a product or a service. So two of the most important metrics today that people look for is, how do I save time doing this, and how does it make my life more convenient? So starting a tech venture today has a lot more metrics to consider or foundations to consider versus starting a venture or a business 2 or 3 years ago. What are some of the things that typical venture capitalists look for when investing, but specifically from a NetBank venture capital perspective, what does our VC team look for when we look at strong founding teams on the continent? At the core, we look for great teams. We prefer founders that have a profound knowledge and experience operating in the industry, serial entrepreneurs that have a track record, but more importantly, founders that are mentorable and coachable and have a good personal rapport with the investors. Founders that are accountable to their investors and are willing to learn and grow with their investors. That is by far the most important thing. A lot of businesses, in fact, the majority of businesses pivot several times before they reach a steady state from a product standpoint, but the team is the most important factor. Followed closely by team is TAM, another venture capital term, standing for total addressable market. So having a great team is great for the problem that you're solving. For VCs to understand a size of the opportunity. For a good benchmark is to have a minimum total addressable market of $100 million within 5 years of a venture listing. Ideally, VCs look at that number being closer to $1 billion. Number 3, traction. There is nothing more attractive from an investment perspective than showing some proof of traction, be it early adopter feedback, initial paying customers. And a good benchmark to have as you prepare as a founder for your Series A raise, which is your first institutional raise, is $100,000 in recurring revenue monthly. Number 4, in today's in today's technology world, more often than not, founders and ventures that have a unique piece of technology, something that gives you an edge, be it a patent, be it protective IP, something that makes you scale and prevents others from copying you, especially in a crowded market. Number 5, we look at transformative ventures. So we want to see how your idea will transform the industry that you're going after, not just incrementally, but fundamentally. I'd recommend a great book called 0 to 1, written by Peter Thiel, the co-founder of Palantir and PayPal, amongst many other startups, that talk about, think for example of companies like Skype and Zendesk and Spotify. Each of these defined a brand new category that allowed them to dominate for decades. And you normally win a market by being either the first to market or being the best to market. Think of companies like Google, for example. They weren't the first, but they certainly were the best. Number 6, to that point, is timing. Everything in life comes down to timing. Why are you entering a market right now versus your competitors? And last but not least, as investors, VCs need to make a minimum of a 10x return to make sure that their portfolios perform and take into account the significant attrition that typically happens with risk-based early stage investing. So these are the factors that most venture capitalists, and specifically the NetBank VC team, looks at. A quick note on any founders here listening to this when it comes to unit economics. Unlike later stage private equity and sort of more mature stage venture capital, when you're looking at early stage seed, Series A, and to a certain extent Series B ventures on the African continent, there are 3 rules that our team likes to look at. from a unit economic standpoint. The first is, what is the lifetime value of your customer, and how does that compare to your customer acquisition cost? So lifetime value is essentially what is the gross profit that you make per user multiplied by that lifetime. And if that ratio is at least 3, it shows that you've got a steady growth and you have a chance of getting more and more market share with time. We call it the rule of 3. Number 2, we look at your EBITDA margins. Now, we completely understand that most EBITDA margins in early stage startups will be negative. And there's nothing wrong with that. Amazon had 24 years of negative EBITDA, and they're worth $2 trillion today. So as long as your EBITDA margin, together with your EBITDA growth, has a ratio of at least 40, as in your EBITDA growth to your EBITDA margin stays at a total of 40, your growth plus your margins. That's usually a good benchmark metric into how VC investors look at companies with lower EBITDA. So if your EBITDA is lower, that's okay, provided you're growing at a rate that compensates for your negative margins or low margins. And last but not least, certainly, is your growth to churn ratio. So what is churn? Churn is a percentage of people who leave in a period of time. So if you're growing by 40%, it's okay to have a churn of 10%. If you're growing by 50%, you can probably have a slightly higher churn, but keep your growth to churn ratio as close to 4, and if possible, higher. These are some of the main rules when it comes to valuing or looking at innovative tech startups from a unit economic standpoint. And the final thing I'll say is when it comes to valuations of technology ventures in Africa, which a lot of people ask us, is how do you value a company? Is it a function of how long they've been in existence? Is it a function of how much funding they've received? The reality is it's entirely a function of your validation. Have you found a product market fit? And once you've found that, are you able to get a problem solution fit? And we've seen startups that have reached astronomical valuations in a matter of months. We've also seen startups that have been around for 7 to 10 years and are still staggering very low with the evaluation. Stagnating. With the evaluation. So it's entirely a function of what validation you have in the market. Finally, a quick note on what's happening from a tech perspective in the real estate place. This is based on a very prominent report on the South African real estate market from a PropTech perspective. There are 3 broad buckets into the type of innovation happening in the PropTech industry. One is cutting out the cutting out the middleman. And that's essentially by way of peer-to-peer services of products. A market leader for obvious cases is Airbnb, which, as everyone knows, utilizes a platform to connect landlords and renters. So, and things like crowdfunding, peer-to-peer online platforms are a broad category, and we've seen quite a few of them in South Africa. The second sort of broad category is where tech is driving innovation in property uses. So things like cloud working, co-working spaces, augmented reality, AR and VR, online retail stores. All of that falls into the real estate tech disruption agenda. And finally, how technology is driving the efficient use of space. And that's where IoT comes into the picture. So smart buildings. A good example is Lone Rooftop in the UK and Vula Telematics in South Africa. So these PropTech solutions aid the efficient use of space above and beyond just a physical structure. Again, lots of innovation in that industry. I mean, South Africa alone has more than 25 to 30 solid PropTech ventures that cover these 3 subsegments. So as a final note, when it comes to PropTech, and not just PropTech, but venture on the African continent, it is not for everyone. From a founder perspective, you have to be strong, resilient, and really understand your market. And it always seems impossible until it actually gets done. So thank you everyone for listening. The VC industry in Africa is growing exponentially, and we would love more investors, more corporates, more partners, and more founders to come into the space and grow the quality of venture businesses on the continent for the future of our country, our continent, and jobs and livelihoods. Thank you.
Thank you, Zach. That was an excellent presentation and a great perspective of the VC point of view from an African PropTech investment perspective. So thank you for that presentation.